Welcome, everybody. We're just going to wait a few more minutes until we can get the majority of the participants in. So if you would just hold on for a few seconds. Welcome, everybody. We're just going to wait a few more minutes until we can get the majority of the participants in. Okay, why don't we begin? What I'd like to do is welcome everyone to the Academy of International Business's webinar series in conjunction with the Journal of International Business Studies and the Journal of International Business Policy. As many of you are aware, we've been running these webinars for approximately 6 months now, maybe 7 months, across a range of topics focusing on papers that have been published in the last several years in either JIBS or JIBP. This webinar is on finance and international business, looking at a variety of papers focusing on modern practice and new theories, and whether there's a kind of way of informing international business practice and theory using various models coming out of finance. We have 3 speakers: Douglas Cumming from Florida Atlantic University, Woon Leung from the University of Edinburgh, and Mohamed from the University of Leeds. As always, there's my co-conspirator, Klaus Meyer from the Ivy School, and myself as the co-organizers of these events, as well as Renfei Gao and Tunga Kayak at the University of Manchester and the AIB Secretariat, who provide all the technical support and help us be able to do the work that we need to do to be able to run these webinars effectively. Today's webinar is going to be moderated by David Reeb, who is an AIB fellow and at the National University of Singapore. What I'd like to do at this point is hand over to David to introduce the 3 papers, and then we'll move on to the individual presentations. So David, over to you.
It's a pleasure to be here today. A few months ago, Tim asked me to put together or look through last couple of years of JIBS and find finance papers that are really quite influential. So I got to go back and read several years worth of finance papers in AIB or in JIBS. And so I got to really get a sense of where we are right now within finance and international business. And these 3 papers really struck out as really being interesting papers that have important evidence in them. So the first paper is this Angel Investors Around the World by Douglas Cumming and Minji Zhang. This is an interesting paper talking about these angels investors. And I'm anxious to hear Douglas talk about it. He's done several papers on venture capital and angel investors, so he's a real expert in this area. So I'm really looking forward to this particular talk. Then the second paper is actually also in the venture capital space as well, on do venture capital firms benefit from international syndicates? This is a really interesting idea, and it's not the sort of thing that you typically see most of the VC papers doing. And so this is such a clever idea that it's going to be fun to listen to not only what they did, but how they think about it and so forth. And then the fourth paper isn't so much on venture capital, but it's on financial intermediation and about how foreign ownership and bank information environments and this international mobility of corporate governance, how we should be able to be thinking about when firms go abroad and do different things, about how governance moves with them, which is a very interesting concept in and of itself, and especially in the environment, what they've done with it. So we're going to listen to each of these 3 papers. I'll be able to see your questions. on the Q&A, and we'll feed it to them. So Doug, you're going to go first, and I think you have 10 minutes, and then we'll have some questions for you, sir.
Great, thank you very much. Let me share my screen. This is there we go. This is a paper with Minji Zhang at the University of Windsor Adet School of Business. Minji is a former PhD student of mine and really great guy to work with, a lot of fun, very smart guy. And as usual, I benefited way more than working with him than he did with me. Really fortunate to work with him, and we have other papers in the works. So to begin, what's the difference between angels and VCs, and why does it matter for international business? So it's nice to have just a nice comparison. So as David introduced, all of the papers today are about financial intermediaries. Now with angels, sorry, I should start with VCs. The investors into VC funds are institutional investors. So rich individuals, possibly, although extremely rare, but we're looking at mostly pension funds, insurance companies, banks, university endowments. They invest into venture capital funds. And it's quite different than the context of angel investors. Angel investors are often entrepreneurs that have made it really big, and then they don't want to invest in stock markets and delegate their investment decisions to other people. So they like to reinvest their money into small startups with not just providing the money, but also the advice, and they're doing it with their own money. So both are investing in growing private firms. Indeed, often the scale of an angel investment is a little bit smaller, although we have our usual bag of tricks where you can propensity score match between size on angel investments and VC investments and do nice comparisons. Angel investors likewise investing in small growing firms. The second paper deals with the topic of syndication. Indeed, in our project here, we sometimes have syndicated deals, sometimes not. Sometimes angels syndicate with VCs, sometimes not. So we have a rich heterogeneity in the institutional setting. In the venture capital and private equity space, there have been many excellent papers, including the second paper today about how legal conditions affect these intermediaries. And many of these have been published in JITS, but also other excellent journals. And then our gap filling, if you will, is that with angel investors, largely due to data issues, is that it's extremely difficult to do any of these international comparisons. Even on a domestic basis, it has been very difficult to do angel research. Most of the angel papers end up coming out in niche journals. People are very wary about data quality in the angel space, largely because, unlike publicly traded firms, there's no mandated reporting requirements. Data collection is very tough. Angel investors don't like to be found. In fact, they often say that if you're able to locate us and figure out who we are, then that's part of the screening process that they like to figure out between a good entrepreneur and a bad entrepreneur. So data quality issues become very, very tough. So what do we want to do in this paper is do this comparison between angel activity and venture capital activity. And our guess, if you will, is that angel activity is way more sensitive to legal and economic conditions and cultural conditions around the world relative to venture capital activity and private equity. And we had two reasons for this. The first being that in a VC fund, you have very sophisticated due diligence teams. In fact, that's one of the biggest, most important thing that you do at a venture capital fund. And not only that, in terms of the professionalized due diligence, is that there's even limited partnership covenants that constrain investment behavior. And sometimes you need to go back to your institutional investor for the investment committee approval. Whereas angel deals, by contrast, this is personal relationships, informal procedures, individualized decision-making without these constraints of the larger venture capital or institutional setting. And then secondly, with venture capitalists, there's an element of risk aversion with financial intermediaries investing on behalf of others. Whereas with angel investors, it's your own capital, again, more subject to behavioral biases. So that's the first thing that we look at in the paper. The second thing is we consider success of these two different forms of finance, angel versus VC. Angels, we think, are not going to do as well on average, even when you propensity score match by size and other things, considering all things being equal with these deals. We think this is the case due to, again, the professional certification, guidance, network benefits, whereas with angels, they're more individualized without the teams that surround them. So we do find support for these two hypotheses. We have a very large data set. Our data set, if you go into the paper, you get more details. We got this incredible data set from PitchBook. So PitchBook, we found this data set of over 5,000 deals around the world. And just to give you a sense, you think, oh, is that big or not in the venture capital space, for instance, or in the angel space? So if you look at the angel papers that have been published, say, with US only data, very small data sets in the hundreds of observations. Even in the top economics journals, only very few papers get published on topic, and just couple hundred deals, that's all they're able to assemble. So to have a data set of over 5,000 deals around the world, quite incredible. And I'll give credit to my co-author Minji. We together wanted to write a paper on venture capital, went to PitchBook because it was very new at the time we looked at the data. And once we got the data back earlier part of this decade, we noticed that, or at least Minji noticed, says, wait a minute, there's a category of individuals. So we almost stumbled across the data. Nobody had looked at these data. We're just shocked at how many deals that we could find. And so what we see, for instance, just in support about, economic conditions influencing angel investors from one period to the next, no matter how you look at this on an international basis, whether it's by GDP per capita, market capitalization, MSCI returns, that angel deals are way more sensitive to, so they go up and down. They're much more subject to these economic conditions relative to venture capital. Secondly, with legal protections, we know that protecting minority shareholder rights influences equity investors. We've known that since the Laporte et al. Papers in the 80s. What we introduce here is this comparison between angels and VCs, and find that angels are much more subject to these differences. Similarly, if you look at the Hofstede cultural conditions, again, angels way more sensitive to these Hofstede cultural conditions. And then again, controlling for other things being equal, like size, and we have our usual battery robustness checks. So to not take too long, what do we do in this paper? We compare disintermediated angel investments with intermediated private equity and venture capital deals. We have a massive data set, 96 countries in total, including angels and venture capital and private equity deals. Over 80,000 deals, over 40,000 investee firms. So really massive data set. What do the data show us is that angel deals are way more sensitive to economic, legal, and cultural conditions. We also find angel deals are less successful on average. We do our usual checks with propensity score matching. We even have a look at regulatory changes over time to run some difference and differences tests and find very consistent evidence. So there's many ways to extend this type of work. One way that we thought of, for example, is comparing angels with other types of intermediaries and other types of new forms of finance. So say an international comparison of angels versus crowdfunding. And we've written about this in a policy way. For example, in a paper in the Oxford Review of Economic Papers, we have a discussion paper on this. We have a new book. I highlighted a book we published last December with my better half. She made the mistake of marrying me, and there we go. We have done some projects together. So there's some policy discussion, but no evidence on this. Another one could be which forms of finance are better able to help entrepreneurs internationalize? Again, we have a discussion about this in our book, but there's no real formal evidence on it. And then finally, I mentioned data issues across countries. A good example of this, there's Italy-only papers in the Journal of Corporate Finance and the Journal of Banking and Finance. And if you compare their data, which is a very large Italy-only data set, to a much smaller international data set, you see that there's very little overlap in the description of how Italy works with the angel deals. No overlap at all. So that gives rise to questions of how robust these studies are when you're looking at very small samples, and there's extensions and ways that one could do better in these types of projects. So thanks very much. I appreciate the chance to join such a great group of speakers and look forward to the next two presentations. Thank you.
So Doug, we have one question from the audience already, and I suspect we'll get some more like this as well. And that comes down to the issue of control variables. You say, you've matched these, that you've done some matching, propensity score matching. So what kind of control variables are you using, and exactly how are you matching? And what kind of macro variables are you including in here when you talk about this? Doug, you're unmuted.
Sorry, back on. I thought I was scot-free. So the usual things that you like to match on are size, definitely, because angels on average will be a little bit smaller than the venture capital. You want to match on size, industry, year. Those would be the most common suspects to match on. And in international business and other fields, like we often have physics envy that there's a right or wrong way to do things, but we don't have any like law of nature that says you must do it this way. So the thing that we always try to do is show robustness. So if you match on these 3 variables versus these 4 versus these 6 or 10, we end up with the same results. And so we go through that process of showing similarity of results depending on different matching techniques and procedures. So, and the not that I'm a spokesperson for PitchBook, but they are a pretty good data set. I would say, at least for angel deals, it's by far the largest and richest data set that you can find. So if you're interested in angel deals, that's a pretty good, detailed, rich data set. For instance, if the US deals only, the Kauffman Foundation has tried to gather angel deals, and they're a much smaller, narrower set of deals than what you can find on PitchBook, for example.
A follow-up question, Doug, and that is, so when we think of your story here in this paper is about how these organizational structures, one being an angel where they're a direct investor, and one being where they're a vehicle or they're representing other people's money, sort of a thing, right?
Yeah.
But we also know that there is a little bit of a difference in terms of the timing. As a general rule, you would generally describe it as angels are pre-seed, VC is rounds A, B, C, maybe D, and PE doesn't enter into rounds D and E. So how much of the differences that you're finding are due to this organizational structure difference, i.e. rich investor versus the VC, versus how much of it's just where they jump into the process?
Yeah, great question. So, if you imagine a Venn diagram with the overlap between angels and VCs being a small part of that. So we can isolate that small part of that and do the direct comparison that I was highlighting today. But we can also take the broader picture, knowing that angels will get into an earlier stage deal often before it comes to VC. And then even more so, we could look at how angels tie into VCs to see if they are quote unquote friends versus foes. And so those are, in my limited 10 minutes, I didn't get a chance to highlight those different angles of the paper where we ran through those things. But certainly that is what we do in the paper. Today I focused on that, that narrow overlap between angels and VCs, but also, are angels and VCs complements or substitutes? And how does one tie into the other? And we and then we even look at deal success where angels go alone, angels then tie into VCs, or angels simultaneously syndicate with VCs, or so the whole gamut of things. And I could have been here all day talking about all these results, but that's definitely in the paper. Please take a look, or email me. I'm very happy to follow up and talk to people about what we do and are unable to do in the paper, and extensions that I hope other people work in these topics, because we certainly could use more angel papers. It's a much smaller segment of the literature compared to the broader venture capital literature, and I would say mostly due to data issues.
So another question from the audience is, when you're talking about the cultural measures, you use the Hofstede measures, right?
Yeah.
Which,
Yeah.
we're all familiar with just from a legacy standpoint, but there's also these newer ones, Globe, Shorts, and so forth. How did you choose which of these to use? And can you talk about your thinking about these different frameworks and why you choose one over the other and so forth?
Yeah, again, it largely, gets to issues of robustness. And if I remember, we had some of these questions in our referee reports. JIBS reviewers, you got 3 reviewers and they're very tough. They're like, well, what about this measure, this measure, this measure? And so you have to show robustness to each of these, and then even the cultural stuff, you can get time series variation measures in culture, although they tend not to change very much over time. Unlike, say, the legal conditions indices, you can get big variances over time. So we go through a process of making sure the results are robust depending on the specific ones that you look at. And what we saw in the data, if we were to let the data speak to the which ones matter, was really this individualism and uncertainty avoidance seemed to be the two big things that matter from the investment standpoint. And that to us was a little bit comforting, in the sense that that's kind of what we would expect from an international comparison and investment. But indeed, as I like to say, there's never any right or wrong decision in these things. It's all a matter of showing robustness. And if it's not robust, you just got to be honest about it and say, well, if I change up my index and use a different one, it's not robust. But again, as I let the data speak, the data show that the ones that appear to be the most important are individualism and uncertainty avoidance.
Okay. Well, thank you very much, Doug. We're going to go ahead and move to the second paper now. And
Thanks.
Abdul's going to talk about, do venture capital firms benefit from international syndicates? You have 10 minutes, sir.
Okay. Thank you very much for the invitation, and also to present the paper. That was very kind of you. The paper is with my co-authors, and also we work together on other projects. One is Fan, who at the moment works for Global Asset Management in London. From Scheme Business School, who worked extensively in venture capital and also worked quite a lot again with Douglas, and Arif Khurshid, who also in Manchester Business School. In fact, as the title suggests, in this paper, we're looking at something very different. There are so many papers within the venture capital, and they look at a number of things. They look at the why venture capital syndicate. Some of them, they do suggest that the syndication is about risk minimization, and also sometimes also it allows them to get to know each other so that they could invest in some subsequent deals. What we try to ask, a very straightforward question, really. We're saying that do VC, especially local VC firm, do they benefit in the syndication? So because there are so many studies, especially some of the study, as you will see in the next slide, including Douglas and also Esmond, they did find quite a few things that Asian market has opened up to venture capital. So therefore, there are so many Western venture capital investing in Asia. So what we try to ask is that, is it really a good thing for the local VC, and what are the tangible benefits? And provided that you have syndicated with, let's say, foreign, and what happened to you post-syndication? as a domestic VC firm. Douglas' paper already explained in more detail the difference of this VC, private equity, and angel. And normally this is in fact is confusing for some people, especially who are not familiar with the area. But Douglas' paper in fact is very detailed to see the different classes: venture capital, private equity, and angel. So in this paper, we focus more on the angel. And this is in fact where the literature is. There's so many paper on the syndication, which focus more on the VC investor. And some of the early study is by the late Wright, who worked a lot, in fact, on the syndication. And also there are a couple of papers as well. This is just very limited, but there's a range of paper, including Douglas' work. And there's other segment of the paper that looks at the organization learning. That is nothing to do with the VC, but generally to say the outcome of organization learning and how important it is for the investor. And then you do have the benefit to venture capital. So there are a number of studies that look at what happened to venture capital firm when they cross-border and invest in a different market. So this is the three stream, in fact, that motivated our research question. And the reason that we're looking for Asia market, in fact, is the study by Douglas, Esman, and Diane Hatta, who in fact find out that there's so many opportunity in Asian market, and opportunities in a Western market become so limited, especially in the context of this VC firm. So this is now where we came in, and what we said, provided that this is how much we know about the syndication, how much we know about organization learning, how much we know about the benefit to foreign investor. Now, what is it for the local investor? Do they in fact benefit by syndicating and opening their market to this foreign or international VC firm? And that is the focus of our paper. So to see whether there is any sort of benefit. We use a very large data set provided by AVCG, and we do have a number of deals, about almost 3,300, but the detailed information about the data in a paper. And what we did find, in fact, a large proportion of these deals are in China, Japan, and India compared to the rest of Asia. But what we also find out in this data, 65% you have syndication, and of these 35% include a foreign syndication. And what we did find that syndication with Asian VC, because our foreign is that as long as you have another VC firm coming from a different country, we classify as a foreign. And then within the foreign, we do go back and then split further, separate further to see if this foreign VC comes from the Asia versus a foreign VC coming from Europe and US. We bunch them together and we call them Western VC. What we did find, in fact, in terms of the syndication with Asia, so it's higher in China and Japan. They do go more with the Asian VC, which from their perspective are still foreigners because they are based in a different country compared to the portfolio company. But in India, we did find slightly different, that they do syndicate more with Western as compared to the Asian market. What we did find in the result is that post-syndication experience, and what we mean here, post-syndication is going after they syndicate and the deal is completed and try to follow these venture capital, in fact, what exactly they have done thereafter and whether they learn from that experience. And one of the things that comes out is that we did find that they do take more risk. They become more familiar how to deal and screen the deal. One of the key issues typically with the venture capital is that it's very, very risky investment, and there is a lot of time spent on screening and due diligence to make sure that they pick a good deal. And there are also a number of studies that shows that this VC firm, in fact, most of their deals not necessarily successful, despite the fact that they're very keen and they're very thorough in the selection process. We find that they start taking more risk as compared to pre-syndication experience. They start investing in early stage. They also invest on a fast round. This typically in the literature of the VC is considered risky, and only those with the experience are expected to take the step. So we find that post-syndication, they do invest more in early stage, fast round, and also high tech, which is normally associated with the higher uncertainty. And in terms of the performance, we measure through what we call successful exit. Again, this first, I think, was one of the early study about successful exit of the VC as a measure of performance. It was by Douglas and McIntosh, I think around 2000 or 1999. I don't remember exactly the year. This was one of the past study that shows that, in fact, VC having the ability to exit their investment successfully is a measure of performance, because this allowed them to return the money back to the limited partner, which then allowed them again to raise the capital to go back to the cycle of making new investment. So what we did find, so in terms of the exit, you have different type of exit. You have exit through IPO route, where they take their portfolio company to public and then they sell the share and walk away. Another successful exit is to take a company through M&A. In other words, so they are able to walk away with the money rather than losing their money. And what we did find that successful exit, in fact, increases by 7%. Now, we try to look back again to see exactly what happened, this experience related to the syndication with the alliance and so on. We did find that Asian experience increases risk-taking probability by 3 to 12%, whereas Western VC, which include US, Europe, and everyone else, 14 to 23. So it shows that, in fact, the composition of this syndication is far more important if you syndicate with Western as opposed to Asia. So in terms of the risk-taking probability increases, and at the same time also the performance increased by 10.4%. So what we do conclude, in fact, is that the syndication is very important, and the benefit, in fact, is mutual, which complement previous study, because most of the study look at the how foreign benefit by crossing border and investing in a different market. And our study, it does complement by showing, in fact, the benefit is mutual. Results are robust to a number of things. There are detailed discussion, in fact, about the indigeneity. We look at the cultural difference. We look at the market condition. We look at the legal system. In fact, we take all these factors into account to see that whether these benefits somehow are explained by cultural difference, whether explained by market condition, or explained by the legal system. But still, we do find, in fact, that this effect still persists, despite the fact that we control a number of factors, including propensity score matching, among others. So in our conclusion is that we do, in fact, extend previous study from the organizational learning perspective by showing, in fact, that the domestic VC firm, they do benefit by syndicating with others, foreign VC, but most importantly, if they syndicate with Western. And what we do find that the early stage venture, they start taking up more risk, investing more in a high-tech industry, and also they tended to exit successfully their investment. The lesson for the domestic firm from our perspective, or what they could learn from our paper, is that local VC typically they need, in fact, to think more about having a foreign partner in their syndication. And the learning effect, it seems to be more pronounced when you deal with the Western as opposed to Asia. And finally, what we do conclude is that the benefit is mutual between local and VC firm. And this leads us to believe that the alliance between Asian and Western VC in terms of syndication to continue. So an insight in terms of the future, what we could do, in fact, within this area. One is about to understand more about the mechanic of this syndication, how exactly they initiate and so on, explore various performance metrics because we focus more on the successful exit and so on. Perhaps with the data availability, could look at more things. And again, we look at which destination, excluding China and Japan. This is what we've seen so far as attractive. How about other markets with the data availability? These are the kind of things that we could do. Thank you very much for your time and for the invitation as well. Thanks a lot.
So Abdul, let me start with a question first. And it was the immediate question I had in reading the paper. when you look at any of these databases on angels and VCs, they're primarily self-reported, right? So the angel, the VC, the startups, they self-report into these databases. So what we're primarily seeing is people report stuff when they're successful to a certain extent, right? No one, like, on average, people don't report, oh man, this was a total failure day. You know, they tend to report their successes. They talk about their papers that got published. They don't talk about the papers that got stuck in a drawer. So when you're looking at this sample, is there a concern, or is there any way to disentangle how much of the effects that you're finding are driven by the sample that you're looking at are people who had success going forward? And so then they take riskier deals. They learn positive. And the people who had negative outcomes from partnering with a foreigner and they don't report the deals, and so you don't see them in the data. Is there any concerns about that, or is there any way to deal with that? Can you talk about that for a little bit?
Thank you very much, David. That's a very good question. And in fact, it bites everyone working on VC spectrum, because you always have this problem. The database, in fact, we're using is called Asian Venture Capital. They do have a lot of data, and for each VC, in fact, they have information about successful exit as well as the write-off. So it means that they do report both when they are successful, because the data is anonymized. We don't know exactly which VC in fact reported, but the database, they do have an ID that provide information. So in fact, they may not necessarily have the incentive to overstate or understate, because the data is anonymized. But we looked at a number of things in our analysis. For instance, we looked at the control for a ratio, for instance, of the write-off relative to the success, to see whether that, in fact, we've done a lot of matching to match based on those report success versus those report failure and so on. So we've done everything we could, in fact, and very much consistent with the literature. But the issue that you're saying that this could happen, in fact, it is a problem every time that you're dealing with the VC data.
And a follow-up question is, can you talk a little bit about why some firms choose to partner or syndicate with a foreign VC to begin with, and why some firms don't make that choice? Because you're looking at that as sort of your treatment, right? And then you're looking at the action afterwards. What's different about these firms, or what's unique about these firms that makes them partner with a foreign VC versus the firms that don't?
Yeah, again, thank you very much for the question. We don't know exactly why a company chooses to go with the VC. And unfortunately, that information is not available even from the database. But what we do have from the database, we do have company that decided to go with the VC, and we have the company that have not decided to go with the VC. And we've done a treatment. We have used propensity score matching to match, to say that provided you decided not to go, for instance, to syndicate with the foreign, was that really a good choice, versus someone decided to go and syndicate with the foreign VC. So we matched on a number of things. We look at the age, we look at the size of investment, we looked at the number of investment they have done, we looked at the successful exit, and so on. We matched to the point to come almost identical. And then we try to say now, in this matched sample, what happened to those decided to syndicate versus not syndicating with the foreign. And what we did find at the end, in fact, that the syndication, it seemed to have a value.
Excellent. Okay. Well, thank you very much, Abdul, for presenting that.
Thanks.
We'll go ahead and move on to the next paper. Woon is going to talk about foreign ownership and international mobility of corporate governance.
Yeah, thanks very much. First of all, thank you so much for this opportunity to share our work, and for joining this webinar. And my name is Woon, and my co-authors are Yi Wei from Illinois Institute of Technology, Iftikhar from Fordham University, and Cheng Wei from Cardiff University. And our paper has been accepted in JIPS, and something that we are really proud of. And so start off with the motivation. And over the past 2 decades, there has been increased a foreign bank presence in a number of countries. So there has been a dramatic trend of banking globalization. And the banking sector has been very important to international business but received relatively less attention from IB scholars. And the reason why it is important is because it finances global trades and investment flows of a number of multinational companies. And you can see that, these two, the stability of the banking sector is really instrumental to facilitating trades and also investment flows. The global financial crisis is a very good example that, instability in the banking sector could impair both trades, disrupting the flows across, between borders. And one of the key reasons, as argued by the literature and also practitioners, is that weak bank transparency has been one of the key reasons that leads to the financial crisis, and because it mixes asset risk opaque and also intensify the agency conflicts between the different stakeholders of the banks. So there has been ongoing calls from regulatory bodies and a number of international financial organizations for improved bank governance and disclosure has been ongoing for quite some time. And so what our objective is that we want to examine the role of banking globalization, and in particular foreign ownership, and whether and how it affects bank transparency. So one of the key determinants of transparency is governance. In a bank with a better governance, the management would be encouraged to increase their public disclosure. They would also have a lower incentive to manipulate earnings and also engage less in excessive risk taking. And banking supervision, banking sector is a very regulated industry, and there has been increasing supervision and regulatory focus that try to improve governance in banks. And at the same time, a growing and recent literature in international finance and also in IB has argued that governance is not a static concept, and it's mobile, and it could travel around the world for several reasons. And I refer you to an excellent review by Duck et al. In 2017 in JIBS, and it explains this idea and this theory very nicely. And so the idea is that governance can travel around the world because firms would be motivated to adopt a better, import a better governance systems from their foreign owners for two motives. The first is that an agency perspective argues that they want to import these better governance practices because they want to enhance their efficiency. And at the same time, an institutional perspective argues that they want to improve their governance because they want to increase their reputation, because there has been a demand from the local investors or stakeholders for better governance. So these two perspectives provide a demand-based explanation for why governance may actually be learned or can transfer across borders. And there has been a number of studies showing that governance can travel via cross-border M&As and also foreign ownership. And some of these papers published in JIBS and also some of the top journals in finance, and among others. So these are our main hypotheses. We argue that banks with foreign ownership, they tend to have better information environment. So that's our first hypothesis. And we want to argue that this positive effect would be stronger if the foreign owners comes from home countries with better governance systems and also with a better quality of banking regulations. So we wanted to see, there might be a heterogeneity in this positive effect, and this is driven by foreign owners coming from home countries. And we're arguing that banks, when they become foreign, and they can learn from these foreign owners with better practices. And then we also have hypothesis 2B argues that even within the foreign banks, we should be able to find that the differences between the governance quality between the home country and the host country can also explain the quality of the foreign bank's information environment. So we wanted to explore the variation between the difference between governance and banking regulatory environment between home and host countries. And we argue that such difference can explain bank information environment. And we argue that this is consistent with a learning sort of hypothesis. This learning is more effective when the physical distance between the home and the host country is small, But this learning effect will be weakened when the distance widens, because the main reason is that we argue that the monitoring by these foreign owners would be more costly if the home country and host country are further apart. So these are the main hypotheses we're trying to test. And so we gather a sample from bank scope. So we have over 700 publicly listed banks from 60 countries over the period from 97 to 2012. So we have the two main variables that we are of interest. The first one is we're trying to capture banks' information environment by how synchronized the bank stock returns are with respect to the market returns. So we have this measure of bank stock price synchronicity. The more synchronized bank stock returns are with the market returns, that means there will be less bank-specific variation in incorporating these returns. That would be consistent with a poorer information environment. So we estimated an expanded market model using the bank stock returns and their respective domestic market indices and the lag terms and forward terms of these. And the details can be, I invite you to read our paper for more details. So we obtained the R-square from this model. The R-square would capture how synchronized bank stock returns are with the market returns. So this is the measure. We have log transformed the measure following the literature. So this is our main outcome variable of interest. And then our independent variable of interest is foreign ownership dummy. The data comes from the foreign bank ownership data set compiled by Claessens and Van Horen, 2014 in JMCB. And so they have foreign bank ownership data, and they classify the bank as foreign owned if they have if there is more than 50% foreign ownership in the bank, and zero would be it's a local bank. So here are our results. We find that we find support for our hypotheses. First of all, we find that foreign banks have significantly less synchronized stock prices, and the economic magnitude appears to be quite sizable. So comparing foreign bank and local banks, the R-square from the expanded market model differs by 17.3%. So we find that foreign banks tend to have more informative stock prices, consistent with the better information environment. And we find that such effect is driven by those foreign owners when they're coming from home countries with above median governance indices. We have three indices. We have indices for the shareholder rights and self-dealing index, and also another worldwide governance index. And we also have several proxies for the quality of banking supervision and regulatory strength, using a worldwide survey by Bath et al. in a various version of this survey. And we also find that within the foreign banks, home minus host differences in governance. In other words, when home country have better governance than the host country, so the home country refer to the country of the foreign owners, then the synchronicity would be lower. So in other words, it's the information environment is better. And such negative relation between, such effect it's also associated with geographical distance between the home country and the host countries. So we find support for our test, and in our panel regression, we also include bank fixed effect. So we are exploring within bank changes in the foreign owned status. So the result continue to hold even when we have bank fixed effects in the model. So we believe this is an evidence consistent with foreign ownership improving the information environment of the banks. And we perform a number of other tests to deal with heterogeneity. For example, we have an instrumental variable estimation. We also estimated dynamic panel GMM system tests and some Hackman correction models, etc. And we also show further tests showing that foreign bank stock price actually contains significantly more future earnings information. So it's not just, there's maybe some concern people may have doubts about how valid our measure of synchronicity is. So we provide additional tests to show that it's actually foreign bank stock price actually contain more future earnings information. And another concern, which is very rightfully pointed out by the referee, is that relying on stock prices and in our measure of construction of this synchronicity measure may be measurement errors because some firms, some banks in less financially developed countries, they may have their stock prices would be less less trading, and there would be a fewer number of banks actually being listed in those exchanges. So we use an alternative measure. We use discretionary loan loss provisions, which do not rely on stock prices. So we have a much larger sample of global banks, and then we continue to find that foreign banks have a better disclosure quality by analyzing discretionary loan loss provisions. And there's several research questions that we are quite interested in and think that would be quite interesting to look into or for an extension. First of all, in our paper, we have looked into the, yes.
You need to kind of wrap it up, okay?
Okay, yeah, very quickly. And so the last point I would like to talk about is another really interesting thing would be the banking globalization. What is the role of it in times of market distress? Especially, COVID-19 pandemic, is it an opportunity or is it a threat for foreign banks? And has there been any strategic focus changes in the banks, etc.? I attached to my reports there as well. And yes, thank you very much, and welcome any questions and comments. Thank you.
Okay, let me start with a couple questions here. So if I understand the analysis, which is really quite an interesting concept, you have these foreign banks who, these entities that own part of a foreign bank. And then what you do is you're testing their price informativeness, right? So this is like sort of a levels regression in that sense. Can you look at changes when there's a change in the amount of foreign ownership? Is there a subsequent change in year 1 or year 2 or year 3? So we can understand how long it takes to transfer this information, or if they are transferring information?
That's a really good question. Actually, in our working paper version, before the review process, we did have done a test looking at the changes. We identify the changes in foreign ownership status in our sample. We identify about 40 to 50 these cross-border merger cases, and then we look at difference in difference. We match them with banks with similar size and coming from the same region and country, and we do find that in the next 1 and 2 years, it does have an improvement in the price informativeness. So we think this is an evidence consistent with an improved informativeness. Yes, but how long? That's a really good question. Yes, we'd like to know more. Yes.
Because since you found you say some amount of this price informativeness, it'd be nice to know how quickly, like what if there's 100 basis points to be gained or something of that nature, does it take 1 year, 2 years, 3 years from the transfer of this information? Or is it something that just happens automatically, almost immediately, right? That it happens within like 3 weeks because they just immediately demand better performance? That would be very nice to be able to tease that out and see.
Yes, agreed. Yes, very good idea. Yes.
So another question becomes, how do you select 50%? Is there any particular reason to use 50%? Why not 30%? Why not 70% or 20%? Or what's magical about 50%, and how robust is it to other cutoffs?
Well, ideally, we would like to have more variation coming from this foreign ownership variable, actually, but it's the data is not available. First of all, the data is coming from prior work by Carsons and Van Horen in 2014, where they have compiled this foreign ownership database. And actually, the ownership structure for the global banks are very complex, and so in their practice, in their paper, they classified it in 50% and use it. So I think what we're doing is we follow the literature, and of course, using a more continuous measure would be better, but at the same time, there would be a trade-off of measurement error at the same time. So, so this is something perhaps in future research, if there are better data sources or there are improvement in the data, perhaps future research can try to use a better measure, I hope.
Okay. And how do the foreign bank, how is this foreign ownership, how how do these banks choose which banks to go into, or which firms to go into and which firms not to? Because you have some firms that don't have any of this foreign ownership and you have some firms that do, right? In an ideal world, we'd have like a random assignment of that, which we never get, of course. So can you talk a little bit about how do you think firms do make this selection and how it affects how you think about this problem?
I think the determinants of why firms would, choose certain banks for, foreign investment, it's itself, it's a very interesting question. And there has been prior study showing that, institutional investor, foreign investor, they prefer, countries or, with a more transparent banking regulations or information environment. So I think this institutional setting thus is an important consideration for foreign investors for sure. And the location, of course, if the bank is located nearer to the, in a bigger market, in the capital city, and they will definitely attract more capital. And these are, so in other words, we do consider these, but these would be more like a indigeneity concern to our test because the treatment status of foreign ownership is not random, and so these are some of the reasons why it's not random. So we try to deal with these indigeneity issue by using two instruments, and the first one is how far exploiting the location. If the foreign banks are nearer to the capital city where the main commerce takes place, then we expect more foreign investment, and we do find a positive relation. And the other one follows the economic literature, looking at the how far is it from the equator, because a prior study shows that it's related to the institutional development. So I hope I addressed your question, but it's a very interesting question in itself, and yeah, thank you.
Well, thank you very much, guys. You guys did really wonderful presentations. I thought I learned a lot, and thank you for letting me be part of it. Tim, I think it's back to you now, sir.
Yeah, thank you. As you know, one of the organizers of this, I get to ask the last set of questions to everybody, and there's a whole series of kind of what almost would be considered to be existential threats in the last few years. We focus a bit on COVID. And the effect that has had on things like unemployment, government centralization, the enormous borrowing going on the part of governments to fund different types of activities. So you have kind of the COVID pandemic coming in. At the same time, you have an erosion in a number of areas in terms of institutional structures. Or at least institutional structures under threat. The most common discussion of this being around populism, but not only around populism, but things that have been going on in Hong Kong recently, things have been going on in Turkey, things have been going on in a number of other areas that would have been considered to be more stable than we've seen in recent years. And then the third, which is probably a bit of a consequence associated with this, has been kind of the threats to global trading systems. So, they show up in things like deglobalization, but they also show up in terms of the nature of conflict. So the trade war between the United States and China, the current discussions going on between the UK and the EU, and on and on and on and on. So you have these kind of number of different things that are kind of arising. And I guess I'd like to go back to each of the panelists and sort of say, okay, how does that set of threats or that set of changes kind of bode? So in the case of Douglas, obviously you say, well, there's a big effect here associated with GDP. Well, if GDP drops by 20%, unemployment goes up by an enormous amount, what does that mean? In terms of Abdul, you've got issues related to, what are you really learning here? And are you really kind of, is the syndication under threat because of the nature of these structures? But also you have kind of the oddity where, for example, some of the biggest gainers from the pandemic and the recent effects have been very wealthy individuals. And therefore they potentially opened up opportunities, right? So I guess I go back to each of you in order. So Douglas, then Abdul, and then Woon Sao, to sort of say, okay, well, how would you speculate on this in terms of looking forward, not looking at back and looking at your data, but saying, okay, well, what advice would you provide, in this environment? So Douglas, first you, and then Abdul, and then Musa.
Super. Thanks very much. That's a great question. Unfortunately, this week, the thing, in addition to those things that you mentioned, the thing that's sort of forefront in my head is politics. So how does politics interplay with this stuff, which is actually causing me to lose sleep, thinking about the craziness that's going on, at least in this place that I've moved to 2 years ago. So that in addition, if we were just to extend from our work that presented today, these massive fluctuations with COVID and other things, we think that would have a harder hit on the angel sector than the intermediated sector. But that's not the only element, of course, and there are some growing differences in inequality, other shifts that could influence these things. So it does, in some ways, massive changes is really great for academics that work with data, because it gives us this whole new range of things to go, I got my next papers that I can work on, whereas the boring times that are nothing changes, you're like, oh, no more experiments to work on. But indeed, these are nice shifts that are happening, and certainly a proliferation of COVID papers. Someone suggested to me recently, like an oversupply of COVID papers these days, and how many of them are actually going to be influential. But in the IB area, I think it opens up a lot of fascinating issues, and it's not just COVID, but it's COVID meets the intersection of politics and other global shifts that you had identified, and that's nice for angel and venture capital work, but that's certainly not limited to that area. And we have lots of new things that we can work on that build on the great work of others and the other panelists. So let me turn to the other panelists. Thanks for that great question. Thanks.
Abdul.
Thank you very much. Douglas, he is an expert in the area, and by looking at what we did find, in fact, that this alliance between domestic and international seem to be important, but in the light of what is happening with the COVID and so on, and these political unrests, possibly it may have some sort of impact, but it's not really an impact that will sustain over a long period of time, because it seems that both parties, they do benefit through this syndication and working together, which is very helpful, especially at international setting. So one thing that we don't really know is how will be the impact and how that will be filtered or included within the return, how this will affect really the return. So if the costs, for instance, tended to be very high, what will be the outcome and how that will affect the performance, and whether that at the end could lead to collapse of this alliance, that I don't know. But given what is happening, because this is almost affecting every single country, and it could be that perhaps we may expect perhaps to have more alliance. And the political risk, yes, is one of the issue, but most of the study, they do find that this political risk, they have an impact, but not necessarily an impact that could somehow lead to eliminate all these alliances that we've seen at international level.
And Woon.
Thanks for the question. And I think foreign bank ownership, although there has been an increase in the number of foreign banks around the world, it remains controversial for a number of countries, especially emerging markets, and in some continents, foreign banks tends to be, the presence tends to be low, and I think what we have documented, it's a bright side of foreign bank ownership, and it helped to improve the information environment. And so there is definitely a benefit. And of course, there would be associated costs with foreign banks. Otherwise, there won't be, why not all the banks all countries open up their entry for foreign banks. So I think the costs and benefits, the trade-off would be very much different under, the current pandemic outbreak and the post-pandemic economic crisis that we're anticipating. And I have seen quite a number of articles looking at how the pandemic affects the banking sector. The lower interest rate due to the stimulus package will reduce the bank profitability. But at the same time, from a foreign bank perspective, local businesses may draw down on the lines of credits from these foreign banks a lot. So creating lots of exposure, and creating more burden for certain foreign banks. So, and there also been some people, are arguing that perhaps banks is taking this opportunity to go full on digitalization. And so this could be an opportunity for banks, and but at the same time could be a threat. So I think this would represent very interesting research questions forward for banking and IB and the intersection between the two. Yeah.
Okay, so thank you. What I'd like to do at this point is to thank the various presenters. Thank David Reeb for doing a marvelous job in moderating it. Also to thank the co-authors, obviously, even though we only use one presenter. And to thank, of course, Tunga and Renfei for doing all the background work. As usual, we are progressing along with new webinars. The next webinar is on the 19th of November. Klaus is going to be organizing that. Saul Estrin will be the moderator. Speakers will be Payson, Sergio Lazzarini, and Aurora Janine. And it's going to be focused on state-owned firms as innovators. Note when you register for this that the time is different. So it's going to be much earlier to accommodate the Asian and time zones a bit more than we've done in the past. Also, you can look at the other webinars that will be available on the AIB World. The presentations are on the YouTube channel. So this presentation will probably be up in a few hours, but all the prior webinars are available to you either to review or use in your classes. So if you see value in that, just go to the YouTube channel. All of that's publicly available. So without much further ado, what I'm going to do is bring the proceedings to a close and thank David, thank Douglas, thank Abdul, thank Woon Sao, thank Klaus for being my co-conspirator, and everyone have a good day. So thank you very much.
Thank you. Thanks very much. See ya.
Thank you.